Good morning, everyone. Thanks for tuning in today. My name is Matt Wilson, and I'm the Finance Officer here at DuPage Foundation. On behalf of our board, investment committee, and staff, I'd like to welcome you to today's webinar with our partners at Northern Trust. Before we start, just a few housekeeping notes. Today's webinar is being recorded and will be made available to all participants. If you have any questions, please use the Q&A feature at the bottom of your Zoom window. We will address them during a segment near the end of the hour. With me today is David Weiss. He's the Vice President for Finance here at the Foundation. And then joining us from Northern Trust, we have Marty Morris. He's the Senior Vice President and Portfolio Manager with the Foundation and Institutional Advisors Group. And then our presenter today is Ryan Boyle. He's the Senior Economist at Northern Trust. So with that, I'll pass it over to Ryan. He could take it from here.
Yep,
Oh,
actually,
Marty, I'm sorry.
I'm going to jump in. Yeah, so I'll share my screen for everybody. All right, just real quick to kind of go over today's agenda. I'll give a quick introduction, then I'll pass it over to Ryan Boyle, who's going to give us an economic update. And then we'll go back and take a look at the portfolios, look at the asset allocation and the performance of the portfolios, kind of put the first quarter into context. So hopefully everybody's familiar with Northern Trust. So anybody that's not, so Northern Trust is one of the nation's largest financial services firms. We have a global reputation for investment management, custody services, and it's really underpinned by our strong culture of service, integrity, and expertise. And that expertise extends to the nonprofit sector. So who are we? Our foundation institutional advisory team was set up back in 2006, really to service nonprofits, other tax-exempt organizations almost exclusively. So we're a national consultative practice, really dedicated to serving the specialized investment needs of foundations, endowments, ERISA plans, and other nonprofits. Primarily working with them on investment management, asset allocation, manager selection, custody, and specialized performance reporting. We've grown our practice, so we have almost 400 clients now, near $15 billion in assets under management. And the next page just shows some of the specialized services that we offer our clients. It does include investment management, account administration, specialized nonprofit banking and credit to our clients, along with some philanthropic services like donor advised funds and planned giving. So really, just to summarize, clients work with us to get access to our sophisticated investment solutions, strategy, our insights, and our world-class resources. One of those world-class resources I'm happy to have with us today, Ryan Boyle. He is Northern Trust senior economist. And so he works very closely with Carl Tannenbaum and the economic team, providing some valuable resources to our investment clients, helping to navigate some of the cross currents that we've been dealing with in the economy, kind of year to date, and really for the past 12 to 18 months. So with that, I'm going to pass it over to Ryan to give us what's on his top of mind.
Sure thing. Thanks very much, Marty. And first, let me say thank you all for bringing me back. There is no better compliment you can pay a speaker than a repeat invitation. Looks like I was last with you last August. Different world. Not even a year ago, but sure felt different. Certainly an uncertain time, but a different set of tensions that were on our mind. Just trying to put my mind back in last August. We had just endured, in hindsight, the worst of inflation. I think, was it June or July, came in at over 9% year over year. Pretty sure it was July. That felt bad. So I was probably speculating, probably crossing my fingers as I presented, saying, okay, we're probably through the worst of this. It's poised to improve. So much of this is driven by energy and by Ukraine, and we're taking policy actions against it. And it looks like that worked out pretty well. Inflation, as I'll discuss, still high, but better than the painful levels that we saw last year. I'm sure I was speculating about, wow, the Fed is taking this seriously. I can't believe they went to 75 basis points. And boy, they kept going. They kept fighting really hard. But it looks like that cycle has just about ended. It's one of the turning points here. We weren't worried about tensions out of the UK. I was always skeptical of crypto. I wasn't expecting a reckoning, and nor was I especially worried about any bank failures. So we never quite know what's coming next. And should I have this pleasure of being invited again next year, who knows what I'll be discussing. But I think we're facing a lot. We have faced a lot. And just a broad point, I always like to remind everyone, don't lose sight of everything we dealt with. We've been through a lot. Don't forget what 2020 felt like when we simply didn't understand what was going on. It was a scary time. We couldn't predict what was next, and yet we're here. We got through it. We're back to work. We're honestly thriving in many respects. We dealt with supply chain challenges. We dealt with figuring out the future of work. We dealt with the Ukraine disruptions and energy and food prices spiking. We've been through so very much. So now, of course, I'm going to start out talking about the recent financial sector stress, and I believe this, like so many other challenges, we can get through, but we do have to understand what happened and what's driving and what we may have to be worried about. I'll try to hold to a half hour or so, and I'm always eager to take your questions, but we'll just, for a Zoom session, it's better to do that at the end. Fundamentally, what drove all of this, and fundamentally, all comes back to COVID, but COVID caused various supply chain disruptions, which sparked inflation. A lot of stimulus measures contributed to other sorts of inflation, ability to buy. So we saw inflation take off. Central banks reacted in a big way by raising rates. I do give the Fed credit for taking that part of their mandate so seriously when they could have said, no, this was all pandemic. This was Ukraine. This wasn't us. This wasn't a monetary policy problem. And it's true. The Fed could not have stopped the pandemic. They didn't develop a vaccine. They weren't doing the virology research, but no, they took it very seriously. They didn't cause the inflation, which also means they can't do very much to fight it. All the Fed can really do is manage its balance sheet. So how many treasuries and mortgage-backed securities is it buying or selling? And it can change the cost of overnight debt, which tends not to really affect the economy in a rapid way. But when you hike by 4.5 percentage points in a year, that does have some consequences, and that's starting to flow through into the financial sector. Really, all of us, whatever you do, if you're dealing with finance, even on a consumer lending basis, we have to adapt to a new world of higher interest rates. This is the new regime. There's opportunity for the Fed to cut. I don't think we'll hold where we are today for more than a year, but this is the new normal. Zero interest rate policy, that was a different set of challenges, to be honest. That's not the norm. I don't think we'll return there. If we do return there, it's a sign a different crisis is upon us. But we are seeing the consequences of higher interest rates are starting to flow through, and it contributed to the failure of a bank. Here's where we're seeing, the Fed policy in action. The one in the upper left is most concerning, that money supply is falling. For, I think, 6 months at this point, we've seen the supply of money actually turn downward. That doesn't have a lot of precedent. Money supply is easy to ignore. It used to be considered a primary driver of inflation, and that relationship kind of fell apart. But generally speaking, just in the background, money grows when loans are made. In an economy with a growing population, growing employment, you would expect more money to continually be printed, and it's an afterthought until money supply suddenly spikes by 30% or so. Then it has inflationary consequences, and it's a sign that we probably overdid some of the stimulus, that there's too much money out there now, sloshing around, not being put to a productive end. Where it is ending up is in money market funds in the upper right. If you don't know where to put your reserve treasury amounts or your own money, go to a money market fund. They can go to this relatively new facility from the Fed called the Overnight Reverse Repurchase Program, investing in assets as safe as U.S. government debt, and we'll talk about the debt ceiling a little later, earning 5% annualized returns. That's very attractive. I don't know where you bank. Odds are your bank deposits are not paying 5%. So pretty easy to move. consumers and businesses never gave a whole lot of thought to returns on their bank accounts for a very long time, because kind of wherever you went, even if you shopped for the best rates, they were never very good, not really worth the effort of switching. Now there is some reward to be had, and that is causing deposit flight away from banks. It contributed to the challenges of Silicon Valley, and it is an issue really for most banks to, not that it's going to kill anybody, but it means that banks are going to pay more for their funding, whether it's directly to their depositors or through wholesale markets. Silicon Valley Bank specifically, what caused this current round of uncertainty, had some problems. And I've heard, as I sit in risk management, I've heard a lot of grumbling about just how much work the whole industry is having to do, because one bank made some pretty novice mistakes in terms of mismatching their assets and liabilities. Banks receive money, and if you're a bank that services the tech sector, you receive a lot of money in deposits. Banks have to do something with it, ideally extending those deposits out as loans, but they're more often invested into assets like treasuries. Silicon Valley Bank bought too many long duration treasuries, and when their deposits started to fall, they were unable to meet and still cover their liquidity ratios, and that sparked panic, led to deposit flight in a hurry. We watched a bank run happen in real time, and if you work for a bank, that's horrifying. If you're a bank manager or a bank board member, you're not supposed to see that. You're not supposed to see it happen as quickly as it did, and watch it play out publicly on social media, and watch deposits moving instantly. You don't have to run to a bank branch to get your money anymore. It's a quick online transaction to move. So that was really stunning to see the FDIC fail a bank during business hours. That had never happened before. There's a playbook for a bank that needs to be shuttered, and it happens end of the day Friday. The bank closes its books, clears the wires, pays the checks, and that's the end of that bank. And over the course of the weekend, it is forced to merge with another bank. What we saw with SVB was, this bank is closed. There will be a bridge bank. We'll get back to you on Monday. And that caused all sorts of uncertainty. It's the only time my boss has texted me on a weekend, you need to jump on an emergency call. All right. We were all very nervous until those emergency measures were announced late in the day, Sunday. Bank runs are scary, and we all know that they're bad. And what makes them so scary is, under the right circumstances, any one of us could be drawn into one. It's perfectly rational to want to pull your money out of a failing bank, even if there's an assurance that it'll be worked out and you'll be made whole. What if you can't make payroll next week? What if you can't service your next bond coupon payment due at the end of the month? Those are real risks. So yes, businesses especially were pulling their money in a hurry out of SVB. Deposit insurance, nothing new here. Only available to U.S. depositors up to $250,000 per institution. Not new. It's been at that limit since, I think, 2010 or 2011, following the financial crisis. For most households, that's more than sufficient, but for businesses that often carry millions of dollars of operating capital, you don't want to put that money at risk. You just move it somewhere else. Like, you never really had to think about it before. So now that we're thinking about things like uninsured deposits and unrealized portfolio losses, that leads to a feeling of a lot of tension. And that's going to be a drag on the economy. Where we're kind of stuck now is figuring out, how much is this going to weigh on the economy and on financial conditions. The bank sector in general is taking it on the chin. You can see in what's otherwise been an okay year in the equity markets, largely sideways, some growth hits here and there, but certainly not another 2021 year. Bank stocks, by and large, are getting punished. A lot of worries about the prospects for higher regulation, maybe need for more capital, or just a lot of uncertainty there, and it's showing up in equity prices. And in the past, when bank stocks have fallen, that has made banks a little more conservative. That's been the prevailing narrative here. There are high tensions in the financial sector. There's fear of more regulation. Banks are going to become more conservative. They're going to value their trust more so than their growth. And in order to maintain that confidence, they will extend fewer loans, take fewer risks, get through this cycle, and then focus on growth one day in the future. And that does appear to be underway, though it's not clear to me that it's entirely an economic risk. So let's stick right there. I just jumped one slide to focus here. Banks are slowing down. But here's where it's hard to interpret. Had Silicon Valley Bank never happened, or maybe not till the summer, We already had the first quarter senior loan officer opinion survey before anything went down, and we knew that bank lending standards were getting tighter. Banks were bracing for a slower year. They were less willing to extend credit, and they reported less demand for loans. So now there's this conventional wisdom that there's tension in the sector and we're going to see less bank lending. And to start the week, sorry, it's not shown in these slides yet. We saw predictably this report extended these lines just a bit. On the margin, banks are tightening their standards a little more and a little less willing to spend. However, demand for loans did not recover either, except for the consumer sector. Still demand for consumer loans, even mortgages. So consumers are still holding up, and they've been, the stars of this recovery thus far. Hopefully they can continue for some time to come. But this is where I'm hesitant to draw strong conclusions, because if the sector was already tightening regardless of SVB, is this really going to be the marginal event that changes the trajectory of the economy? And if you, especially on the commercial side, if you need credit, banks are one channel for that, but they're not the only one. There are bond markets, there are private investors. There's a lot of liquidity still out there seeking a home. So just because banks are less willing to extend credit doesn't mean the economy comes to a screeching halt. It's hard to say this is what pushes us into a recession, that this is the event, that this is the something that broke. The Fed hikes until something breaks. This was the something. That's not entirely clear to me, but on the other hand, nothing about this is supportive of growth. When we're talking about these sorts of tensions, it casts a shadow across the broader economy. One other risk, maybe particularly on my mind because I work for a bank, but what's happening in commercial real estate? By and large, this has been a good story. As you think back to 2020 and we wondered, wow, how much of this is permanent? Are we ever going to eat in a restaurant again? What's this going to look like? Overall, commercial real estate has held up quite well. And sector by sector, it's a different story. We couldn't build warehouses fast enough, and they're still under capacity, under demand. Multifamily, as I've got some slides coming up, it looks like we've underbuilt housing for quite some time. Apartment projects are finding tenants very quickly. So many asset classes are thriving, but where we are seeing a persistent disruption is to the office sector. The irony is not lost on me that I'm sitting at home as I present to you today. Because work-life balance is wonderful. I am needed to do the school pickup this afternoon. And let's be honest, if I'm sitting around a lot of coworkers, this is disruptive. I'd have to book a private office or something. Like, this just works well. I'm so glad this is part of the mix for jobs like mine. I'm back in the office 3, maybe 4 days a week. That puts me ahead of the curve of a lot of people. Demand for offices is simply not what it used to be. It's not zero. Some employers, some tech companies did try to go fully virtual or as virtual as they can be. And it does have some advantages, also some drawbacks. But even the busiest employers, most are not back at 5 days a week if you're an office type of tenant. I should have included it here, the Castle Systems data. Every time you swipe your security badge, Castle Systems is probably providing that software that's unlocking the door. And they're tracking city by city how much badge swipe activity is happening relative to the pandemic. And nationwide, it's about 50%. The busiest city that has had the most return to office is Houston at about 60%. And that's not to say 40% of workers went away. That's 2 days a week went away. 100% of us are still working, but we're not 5 days a week. So how do you justify having that same amount of office space? It's difficult. We come in a few days a week. It's our anchor day. We meet, we have our lunches and happy hours, and we go home and we have more flexibility to manage our lives. It's great for just about everybody except the owners of office real estate or the lenders who are lending to those owners. We have to keep an eye on this. It's not going to be a fast reckoning, and it's not going to be peril. Banks are pretty good at commercial real estate lending. They reserve for potential losses. It's going to be a little treacherous as these 5 and 10-year loans come up for renewal. It's a different market now than it was in 2013 or 2018. Cap rates are important. That's the ratio of income to the value of a property. Incomes are highly under pressure. There's a lot of subletting, a lot of downsizing of space, and valuation is almost impossible. It's hard to find recent comps. There aren't a lot of deals happening, so it's hard to even know what the cap rate is. It's volatile. It's slowing down investor sentiment for this whole sector. It's going to be a challenge, but it's going to play out gradually. Banks have a lot of discretion to modify terms of loans to see what funding is required. No one wants to take control of a struggling asset, so there can be workouts that can happen, and a lot of it will happen behind closed doors. Banks do need to report their loan losses, but they don't need to be specific about where they realize losses or what assets they have, where it's specifically they have commercial real estate exposures. Investors can ask, but they tend not to be revealed publicly. But this is broadly going to be a pressure on banks that'll play out gradually for years to come. Not an incipient crisis, but something to watch. The best analogy I've heard on offices, I forget who said it. It's not an original thought on my part, but think of offices today like shopping malls 10 or so years ago. We knew retail was undergoing a structural shift, but malls aren't dead. Some have closed, some are middling, some are thriving, and some have been totally repurposed. They've gone toward residential or lifestyle spaces, or they're more outdoor rather than indoor focused spaces. Those conversions aren't free, but they show that new life can be breathed into those properties. That's probably where offices are now. The Class A spaces are going to stay in demand. The middling ones, maybe not. Some, probably not all, but some could become multifamily. Some could just middle along. So we're going to find our way through this. The properties themselves are not worthless, but they're challenged. Let's move from there. Those are kind of the immediate concerns. Let's get back to talking about inflation. Can't talk enough about inflation over the past year, and it sure looks like we are through the worst of it. We got a fresh print yesterday. I didn't get a moment to update this chart, but it's about the same. Just a very minor improvement of both core and headline CPI by 1/10. Still moving down, is moving in the right direction. That's good. What was favorable yesterday is it was in line with expectations, even as volatility continues. Used car prices were the shooting star yesterday, up by over 4% in just 1 month. The automotive market remains disrupted, still trying to find what equilibrium is, and car prices have been all over the map. Vehicles are still quite expensive. And despite that surge, core inflation was still trending slightly down in line with expectations. What was really encouraging, what we've been watching, is core services, shown there on the lower left. Been running higher than core goods, running quite high. And it's concerning because core services, so excludes energy, excludes housing. That's a really varied bucket. Major components include auto insurance, auto maintenance, education, household utilities, even like garbage collection and water and sewer, all taking off. There is no common thread there. That shows that you can't just change the overnight interest rate and expect that sort of inflation to fall. It's a sign that once inflation starts, it becomes endemic. What they do loosely have in common is a dependence on labor. Some of those sectors more than others, very often skilled labor. So we have to be very mindful of wages, and I got a slide coming up there, but it just shows there has been a labor shortage. Think of auto mechanics. I mean, I guess anyone can change oil. That's easy enough, but to become a master mechanic takes years. I mean, it's just a lot of on-the-job training in addition to classroom work. Think of nurses or many healthcare technicians. Requires training, requires certification, as it should. Those are important jobs. We shouldn't let just anyone walk in and start doing. But there has been a shortage of that trained labor, and it's taken a while to recover, and it's shown through in inflation. Very encouraging yesterday that was not the hottest sector by any stretch. So perhaps we're through the worst of that piece of the cycle. Turning to labor, really been the most encouraging story of this recovery. Just great to see how well labor markets have held up. Slowing, but not slow. As I say in the headline here, we were overheated, now we're merely hot. Now, look at jobs growth in the upper left. Since the start of 2021, we've had some breakout numbers there. If you were to draw a trend line, you can see it's coming down, but it's not going negative, and that's encouraging. Job creation is continuing, and people are still showing up to take those jobs. It is slowing down. You can see in the lower left, there's been a lot of attention paid to job openings. How many jobs are out there if you're looking? We touched 12 million. That was a record. We are still quite high. We're at 9.6 million most recently. Good to see it's under 10. Good to see it's trending down. But in the prior cycle, it never touched 8 million. It's still quite hot. We're at 1.6 available jobs per unemployed person. That is still a tight labor market, but this is a component of the most optimistic scenario where we can have a slowdown without massive job losses. It is possible to just say we're right-sized, to say we can slow down hiring. We don't need people. We can close some of these openings without filling them, but without needing to let people go. It won't be that easy for a lot of employers, but that in aggregate could be an optimal outcome. We'll see. We're watching this closely. Where I remain encouraged every week, we're checking initial unemployment claims. We got a reading today a bit higher than I'd like to see, touched up a bit. 1 week is not the beginning of a trend, but we're keeping an eye on it. You can see claims are holding a bit higher than the incredible lows that we saw in the second half of last year entering this year. Now they're more at levels like we saw in 2018. Right, there's always turnover, always movement happening in labor markets. So just saying that there were some unemployment claims is not a worry. 2018 was a great year. So this is not worrying. As it gets to 300 and starts to hold there, that could be a sign of net job losses and a rise in the unemployment rate. But thus far, these are not worrying. Certainly a sign that we're cooling a bit. And there, of course, the upper right is wages, trending down, but still, much like job openings, holding at a level that's higher than anything we saw in the prior crisis. We saw wages go up 2, 3, even 3.5% year over year in 2018, and we wondered, oh no, is that going to be inflationary? And that's getting a bit hot. Well, then we saw wages go, it's a 6% overall, and for frontline workers, even higher. That is inflationary. And now it's good to see it's moving down, but it's still holding at a relatively high level. And that's going to make inflation a bit harder to tame. Let's dig a bit into the most recent GDP print, because the headlines weren't great. At 1.1% annualized growth, we thought we could do better. As we dug into the details, it was actually not bad at all. And it motivates this discussion. I probably hit on this last August. What is a recession? When can we say one has begun? So look at that dotted line. That's the overall GDP print. And we saw first and second quarter last year, it was negative for technical reasons. In the first quarter, net exports, our trade balance was very large. So thus that dragged on inflation and led to a negative print. In the second quarter, trade normalized and inventory investments fell off as supply chain challenges were still invading on us. And that was enough to make GDP negative. So isn't that a recession? Well, no. To call it a recession, it's somewhat subjective. It's done by some expert academic economists. It's always done in hindsight. It has to be a broad-based decline across, not just GDP, but more the components of GDP. What about wholesale trade? What about consumption? Employment has to fall off. What's happening on the production side? And we're not seeing those indicators fall in tandem, not by any means. So all of last year, I was never ready to call it a recession. And I feel good about that in hindsight. I had that confidence because look at the red bars. Consumption. 70% of our economy is consumer spending, and it never stopped. Those figures are adjusted for inflation. It's not just that we were spending more because prices went up. People kept spending. This is the core of the outlook. As long as we keep working and our wages are rising, we will keep spending. As long as we keep spending, we can keep growing. Might not be great growth, might not be even across all sectors. It might feel like a recession here and there. And I think part of the reason I'm nervous now is I work in the bank sector and there's tension in the bank sector, just as there was for home builders a year ago or the tech sector over the past year. These challenges are going to come and go across sectors, but broadly, we're still consuming, and that can get us through this. We've got retail sales in the lower left. Here's a spotlight on consumer consumption. You can see the breakneck growth is over, but still growing on a year-over-year basis. In fact, that core retail sales series now has year-over-year growth higher than inflation, right? That's what we want to see. I don't know that this can carry on forever. I don't expect we can grow perpetually. Some normalization is going to happen, but as long as consumers keep spending, even if it feels like a different kind of year, we can find our way through this and not fall into recession. That, I admit, is the optimistic case. Let's spend a little time on housing. We get nervous about housing. We, as a society, get nervous about housing because we endured 2008 and 09 and 10 and 11. We didn't hit a bottom until 2012. That was quite a reckoning. It was a housing-driven recession. We got way over our skis, and it was a painful correction. So now when we see house prices or maybe starting to correct? Do we need to be nervous? I'm not, especially because look what happened to house prices in 2020 and 21 in the upper right, up by about 40% in 2 years. That's not sustainable. All right, that had to slow down. And you can see it's not correcting nationwide. Maybe some markets individually are, but it's just holding flat. That's sort of an arbitrary index value, but think of that as instead of 1991 equals 100, 1991 equals 100,000. $100,000 house, yeah, in the run up of the financial crisis, got over $200,000. That makes sense. And now, wow, did it touch $400,000? Well, relative to 91 kind of makes sense. You can see how that narrative comes together. It's not worth 450,000 today. It's probably holding flat where it was a year ago. What drove that? Predictably, was interest rates. I like talking about housing in this sense because it's the only market where higher interest rates are having the outcome you'd expect of slowing down activity. When interest rates more than double on a mortgage in a span of just a few months, buyers react and activity slows down, and sellers may react by lowering prices. That's what we're seeing. Affordability is not what it was as interest rates have gone up. However, demand is still there. We're still working. Families are still being formed. People do still want to buy, and supply is constrained. For one, it could be psychological. If you know that one day you're going to sell your house, maybe think about downsizing or move to a warmer climate or something, you have time to make that decision and to try to time the market, perhaps. If you had a number in mind and a realtor says, oh, you'll probably get $100,000 below that number, well, what's the rush? You can hold out a few years. So sellers aren't rushing to the market, and that is going to keep prices higher. I don't see what would cause the mass forced selling like we saw starting in 2008 that really caused a correction out in house prices. We're still working. We can still service our debt. But now we can look back. You see this in the lower left. We underbuilt housing for quite some time. We do not have enough inventory available to keep pace with demand. These are nationwide trends. It does seem to hold across most markets. Just falling inventories of housing that's available, whether for sale or for rent. And we underbuilt. You see it in the lower right. There is a flow. First, it's a housing start, which is just paperwork and agreement to start construction on a lot. Then it becomes a house under construction, and then it becomes a completion. It's always worked that way. And I think we can agree, maybe the years 2003 to 07, that was too high. We don't want to get back to those levels. The 90s were much more normal. We never even got back to 1990s levels of house construction. And now we're paying the price for that. That when there was a surge in demand, when people were ready to go out and buy because there's COVID, because we want more space, because I can work from anywhere, I'm working from home, I need a home office, there wasn't inventory available to them, led to a surge in prices. There is still demand out there. Some of it was pulled forward, but there's enough demand to maintain house prices. I'm not nervous about the housing sector, but I absolutely understand why it's on our minds. Let's get to what I'm actually nervous about. That would be the debt ceiling. So a bit here, just quickly on the Fed. I've talked a bit. I think we've seen the end of the Fed hiking cycle. We had a hike last week. They've clearly signaled they didn't want to get much higher than they have just reached. So it's probably the end. And the statement was revised, and Jay Powell was really clear in his press conference without actually saying the word pause. They're going to wait and see for a little while. Can't rule out another hike if inflation surprises us again. But I think the Fed is inclined to wait and to contemplate when it's time to cut. They're in restrictive territory. It's going to come down eventually. Expectations that we could see cuts in the summer are terribly pessimistic. Something has to break badly for the Fed to start cutting in any sort of hurry. The optimistic case is inflation keeps trending down, and once it's well on its way toward its 2% target, that's where the Fed will start cutting. That would be more like end of the year, beginning of next year. We might seriously see some discussion of it. Either way, not likely to keep going up. The bigger worry is the debt limit. It's a frustrating topic. It's a silly policy. I won't get into the politics of all of it. It was meant to be a simplifying measure. It dates back to 1917 when we were in World War I. For the war effort, we had to issue a lot of debt. And as the Treasury was chartered, every time the US issued debt, it needed an act of Congress. And as the war effort took off, bills were going up to Congress almost daily to issue more debt. Congress said, no, this is a bad use of everyone's time. Let's simplify this. Treasury, you're free to issue up to this amount. Come back to us for authorization when it's in sight. It worked pretty well, but in more recent times, it's become a tool to extract concessions when under divided government. So an unintended consequence of a policy meant to simplify everything. What I've shown here, I apologize. This is now a stale chart because this was your Asia group saying we'll probably make it to August before this becomes very serious. But last week, Janet Yellen came out, our Treasury Secretary, submitted a letter to Kevin McCarthy saying it's likely we'll hit our inability to pay our obligations, known as the X date, on or about June 1st. This hit the news and the reaction was, oh, Treasury has to make the most conservative assumptions. Yellen wants to see this get resolved. So of course they're going to give the most aggressive date. But then everyone who dares to forecast an X date, it's impossible to know with certainty. It's volatile cash flows in and out of the Treasury general account. But a lot of estimates just got revised into June, in the first week of June, a general agreement that this thing is coming real fast. That August date assumed we'd make it to June 15th, the quarterly corporate tax payment deadline. That would be a big influx of tax revenue, and that would get us through July. Now, June 15th is looking like a very, very long distance away. And this is becoming pretty serious for early June. Good to see some beginnings of talks this week where Biden brought congressional leaders in. No resolution was expected, but they committed to keep talking. No one's walking away in frustration. And this is almost always, it has always ended in a deal. We've never gotten a technical default, even when it comes down to the 11th hour as kind of by the necessity of negotiation, it will. We've always found a way forward. Treasury stat is what, 78 increases or suspensions in the past 60 years, more than 100 over the history of the debt limit. And often it's an afterthought, but sometimes it gets a bit heated. If we actually enter technical default, it's a whole new era. There's no more question about recession. It's just a question of how severe it would be. It would be a financial crisis, and it would be totally self-inflicted. This is where it gets frustrating for all the time we're spending within the bank, really across the whole sector. What happens to our portfolio? What do we do with defaulted collateral and so on? There's so many issues to be sorted out. There are better uses of everyone's time, whether in Washington or in bank boardrooms. So I do hope we find a way forward. It's going to be tense until the very moment that both chambers of Congress ratify it. My own forecast, this is not a Northern Trust expectation. I think we'll see a clean lift just to September to align this with the budget cycle. The federal fiscal year ends September 30th. We need a new budget by October 1st. Really, if this is a fiscal measure, I think the debt hawks have a point. We shouldn't borrow freely. We should be deliberate and careful about our usage of debt. There's a lot of virtue to trying to reduce the deficit. I get that. Let's make it part of the budget negotiation where it belongs and tie this, the authorization to spend with the budget where the spending is agreed. And if my prediction is right, that means we'll just be in this same moment of tension in September rather than May and June. I'll try to wrap up here. Globally, look, I've been very US focused here, but as I look to other central banks, a pretty globally consistent story. Inflation was a global challenge, largely driven by our global supply chains. Everybody dealt with it, and central banks responded in a pretty uniform manner. I think outside of Turkey and China, every central bank has raised rates, and they're approaching the end of their cycle if they haven't reached it already. One more hike today out of Bank of England. They want it to be done. UK is very likely entering a recession. They didn't want to hike further, but they're reaching record inflation, so they had to act. European Central Bank has signaled maybe another hike or two to come. They'd like to be done. Interesting, Reserve Bank of Australia, not shown on this chart, but they paused and then hiked again. So that could be a sign. If inflation doesn't come under control, you can't say with certainty this thing is over. You can't really say we've seen the last hike until we actually see our first cut. Here's our forecast table. I don't want to dwell on it too much because I've never been less confident in it. As laid out, we have GDP across the top row without any negative numbers. These are not great numbers. These are 0% plus growth rates. They're not strong. However, given the fundamental premise that as long as we're working, we keep spending, as long as we're spending, we keep growing, especially as inflation is poised to continue improving, whether through any number of sectors that have likely passed their peak. We do think real growth can continue. All of that is premised on nothing else going wrong. And after everything we've been through in the past few years, that is a horribly optimistic statement, or at least it can feel that way. And as we're worried about the government potentially technically defaulting or shutting down, as we're worried about the financial sector, wondering if there's another shoe to drop, wondering if there's another bank that could be forced into bankruptcy, is that is it too much to say nothing else is going to break? But I've been pleasantly surprised by this recovery thus far. I do hold out some hope, but the challenges are manifest. I haven't been able to view the chat box. Have we had any questions come in?
No, not yet. If
Okay.
we'd like, Marty, you can hop in here and just review the portfolio.
Yep, sure. I will reshare my screen. So real quickly, a portfolio review. Ryan went through the setup that we're in. So very much there's a tug of war going on. In the short term, still seeing strength in the consumer and basically in the also in the corporate level, and that's balanced against some of these longer term growth issues that we're dealing with as this growth continues to slow in the U.S. So in the first quarter, so it was a really good quarter for risk assets and risk control assets. So we saw equities in the quarter up north of 7%. So a really good quarter for equities. And importantly, we finally got some positive returns from the fixed income portion of our portfolio. Stabilization in interest rates helped out on the fixed income side. Looking at the equities performance in the quarter, so they kind of go under the hood on equities. It really was kind of a narrowing of the leaders in the equity space. So it was driven primarily by the high growth, high tech names. The NASDAQ, for instance, was up 17% in the quarter. So a lot of the positive return we got from equities in the first quarter, at least in the US, was kind of driven by what's going on in the high tech growth names. I won't go through kind of the blow by blow of the quarter. Just kind of setting up on different asset class perspectives. Our outlook for fixed income is a bit subdued. So at the bottom of the page, you can see our outlook for investment grade fixed income at around 2% over the upcoming 12 months. TIPS or inflation linked securities around 1%. And we still think that there's some outsized opportunity on the high yield side with the current coupons north of 8%. And the credit defaults at a near record low, off the lows, but still a relatively low. So we think there's a high likelihood that we'll collect those high coupons over the upcoming 12 months. Shifting to equities, our outlook at the bottom of the page. So the really good first quarter performance in equities that I previewed, the up 7%, that really pulled forward a lot of our expected returns in the equity markets for the year. So as we sit here today, already having the positive plus 7% performance in the first quarter, that really kind of brings our expectations for the remainder of the year down relatively low. So if you look at our expected return for U.S. equities, just under 1% for the upcoming 12 months, and outside the U.S., a little bit better optimism for developed ex-U.S. and emerging markets. But that very much had an impact on the way we look at equities, and I'll go through our asset allocation in just a few slides. On the real asset side, we saw OPEC step in to support oil production. So that's an important indicator for kind of the pricing on oil. So that gave us some comfort to add a small overweight to the global natural resources. It's going to help offset some of our underweights that we have in the emerging market space that's very China-centric. So as we look forward, we do expect a little bit better kind of mid-single-digit returns on the real asset portion of our client portfolios. So from a positioning perspective, this again, for those not familiar, the left-hand side of this page clearly delineates our overweights, underweights, and equal weights in different asset classes. So we are still holding a small overweight to cash, where Ryan talked about the flow to money market funds driven by the near 5% yields that we're getting on money market funds. So we very much are in the camp of having a little bit extra cash. We're actually getting a real return on that cash for the first time in a long time. And it does provide us some optionality and dry powder to either allocate that cash to try to reduce the risk of the portfolio if things continue to deteriorate, or alternatively to press the pedal on risk if we think that there's a likelihood we'll be able to collect some outsized returns on different asset classes. From a fixed income perspective, we still maintain overweight to credit in the high yield space and underweight to investment grade or term long-term exposure on the fixed income side. I talked about our small underweight to U.S. equities. So that again is coming from our diminished expectations for positive returns, is with that pull forward of returns in the first quarter. And then we did add a small overweight to natural resources. So very much kind of neutral on risk in our client portfolios. We're not you're getting out over the ski tips on risk. We understand that there's some cross currents going on in the economy. So we want to maintain a neutral posture on risk at this current juncture. So jumping into the portfolio itself, this is a snapshot of the asset allocation of the portfolio earlier this week. So on the equity side, as I previewed, we are slightly underweight equities in the DuPage Foundation portfolio, primarily coming from an underweight to emerging markets. And on the fixed income side, we're offsetting a small underweight to investment grade fixed income with a small overweight to high yield. And then on the alternative side, we do have a well-diversified alts portfolio that includes real assets, so like real estate infrastructure and commodities, along with the hedge fund and private equity portion of the alternatives. And I did mention cash, so we do have a slight overweight in cash versus our targets. So jumping to performance, and I know these numbers get kind of small, so I'll see if I can zoom this in a little bit. So year to date, this is the performance through first quarter. So year to date, the equity portion of the portfolio up north of 6%. So again, a really good quarter for equities. I talked about the rebound in fixed income returns. So we had about 3.5% returns on the fixed income portion of the portfolio in the first quarter. And then the alternatives portion of the portfolio, which includes commodities, real estate, hedge funds, and private equity, was about flat. If I roll forward, you can see all in year to date, the diversified portfolio is up about 3.5% year to date versus our custom benchmark that we track that was up just north of 4%. So very much tracking in line with the custom benchmark that's denoted down below. From a fund level perspective, it's probably important to note a couple of adjustments we've made in the portfolio, and that's primarily coming on the fixed income portion of the portfolio. We benefited last year with the rapid rise in interest rates, having an underweight to duration. For those not familiar, duration is a sensitivity to interest rates. So as interest rates rose last year, the price of underlying securities went down. So having an underweight to that sensitivity benefited our relative performance on the fixed income side. But we did bring that duration or interest rate sensitivity back to neutral late last year, early this year. So we were able to participate with the fall in the 10-year yield and interest rates in general as the curve fell in the early part of 2023. So that was an important adjustment that we made in our client portfolios that's reflected in the good performance you can see year to date, doing a little bit better than the aggregate benchmark. Real quickly on the private equity side of the portfolio, we don't have updated performance on the fourth quarter mark to market yet. Those are imminently going to be released, probably later this month. So the next time we update everyone, we'll have updated marks on the performance of the private equity portion of the portfolio. But it's sitting here today that the numbers are again very flat because we have not marked that portfolio to market through year end yet.
Hey Marty, are you able to, I guess, I don't know, do you have any sort of sense of where those marks will be at, where they will come in at, if it'll be good, if it'll be bad?
Yep, it's a very, very topical question. I wish I had a clear answer. I think the general understanding is going to be lower. That the private markets tend to get marked at a lag to the public markets, and we did see a pullback in obviously in public equities in 2022. So I know directionally that the private equity will get marked down. It's important to note too that the private equity portion of our portfolio is really valued on cash flows versus kind of the earnings that the public market is. So to the extent that revenues are staying high, and we have not seen a lot of degradation in revenues in the public markets. So I think that provides a little bit of comfort for me when we look at the private side, that the cash flows and the revenues of these private companies, if to the extent that it is holding up, will provide a little bit of a cushion to the downside. But I think it's generally understood that directionally those marks will be lower. So I wish I could be more clear, but again, we are getting those numbers very soon.
And then if you have a chance, could you just give a quick overview on our hedge funds position and the outlook?
Yep. Yeah. So hedge, really for the first time in a while, hedge, as we saw last year, 2022, really did provide some real hedge to the portfolio. So if you look at, for example, kind of the 1-year returns of the hedge fund portfolio, which is down about 2% in the past year, versus for example, the equity portion of the portfolio, which was down, about 7% over the past year. So we consider hedge funds a risk asset similar to equities. It's just a lower risk asset. So they really did provide a good hedge to the downside protection that we use the hedge fund strategies for. So that's really all I had for prepared remarks. I guess maybe we could kind of pause there and see if any questions have come in for Ryan or myself.
I would just interject. I was at a conference 2 weeks ago where I got to hear kind of a fireside chat by the founders of Carlyle, Bill Conway and who's the guy on Bloomberg? David Rubenstein. And they just talked about how they see the interest rate environment as structurally challenging for that whole sector. Current performance probably fine, but finding new deals, it's going to be a whole new negotiation. You cannot assume interest rates will perpetually keep falling, and that really changes what an LBO looks like. Not that they're not possible, but there's a lot of people out there scavenging for deals, and there's going to be some strained margins for some time to come.
Okay, so no questions have come in yet. So in that case, I just want to thank Marty and Ryan for taking the time with us this morning. Thank you all for participating, and have a great rest of your day.
Thanks for having me.
Thanks, everyone.
Thanks, guys.